Okay, very good morning. Wednesday the 7th of February. Don't worry, the world has not ended. Washing machines still break down, cars still break down, the tube's still late, buses still don't run when it's too cold. So the financial crash that we had, being termed by the newspapers kind of this time yesterday, we reverted back to where we are. So we had a really strong bounce in equity markets yesterday, one of the biggest up days we've had in a long time. So we're going to have a look at that. We'll also have a look at, I know Piers talked about this quite a lot yesterday, but the VIX, I've just got an interesting statistic you might be interested in that I can show you from some analysis from our friends at Deutsche Bank. And then we'll look at an update across a few political themes all the way from the US, because of course, not forgetting, of course, the US government could shut down again on Thursday if they don't find a stop gap fix to see funding through to the end of March. And you've also got Brexit, you've also got German coalition talks still ongoing, so we'll have a look at a few of these other things as well. So first of all, talking about the news then before I hand over to Sam, who will look at the charts more technically, and just looking at the rally of which we had from yesterday. And as you can see, really from that move that we had with a really big sell-off that was seen, I'm just actually quite interested to see what the retracement was from that move. The 61 kind of fib retracement of that whole sell-off is kind of where we're sat at the moment. So you can see well over half of the move was already recouped, and the predominant amount of that move coming really from the off and the open on Wall Street, which was really from here. We had quite a bullish open. Oil prices, if you remember yesterday, at around the time of 2:30 London, were rallying quite aggressively. And then we just continued to move higher because quite a lot of the bigger banks have been out, and it's the familiar rhetoric where if you start discounting a lot of the volatility-linked strategies that obviously got hurt quite badly by the record jump in the VIX index of 116%. People like Goldman's last night were commenting that the stock market correction appears to be more technical and positioning driven rather than fundamentally based. They believe fundamental drivers of the equity market remain intact, and they were out last night reiterating their S&P 500 year-end call for 2018 of 2850. And so many people thinking that move, and we were the same here, we were talking about that yesterday morning, that possibly this overdone, the sell-off overextended and exacerbated by the kind of the function of algorithmic trading that took place on that large-scale sell-off. So that's kind of what happened yesterday. And this morning, although we've seen a bit of a dip in futures from where they closed last night on Eurex in case of the DAX and the centre left, we are still in positive territory, and the Euro stocks likewise. So we are trading with our heads above water for the time being. But obviously what the beginning of the week was a very stark reminder about how quickly obviously market conditions can change. So one of the things I did want to just quickly show you, which I thought was quite amazing this morning, was we talk about quite a lot, Will does in his behavioral finance and psychology sessions, about the market being very much a reflection of the sentiment of the investment community. And what you can see here in this pie chart is the type of market participant who's currently trading in this current day. And more than half of fund managers have 9 years of experience or less. I thought that was quite amazing, actually. Now, a lot of this actually was a byproduct of the wake of the financial crisis. What actually happened was a lot of the kind of more expensive staff, so the more experienced ones, were the ones that actually were either pushed aside or left, and a lot of the kind of the technology advancement of having more automated systems has meant that actually there isn't really such a necessity for experience anymore. The guys who've been in the market 20, 30 years. And so actually it's moved over to a much lower level of experience in the market. And a lot of these guys who are making these investment decisions weren't even really around during the financial crisis, going back to 08 and 09. And so when you see an episode of volatility, like when you had the Dow fall and close 4.6% just the other day, that, not to sound like a broken record or an old man, but that was absolutely business as usual during the financial crisis, day after day after day after day. So it's just quite interesting though, because really, if those more experienced people aren't in the marketplace, then technically this market might react in a different manner, because these people, this is the most volatility that they've ever seen, so the decisions that they make on the back of this will most likely be quite different to that of someone with a much greater length of experience. So yeah, it was just quite interesting. You can see the kind of predominant basis here is mid-career, so 32%, it's almost a third of all these fund managers have gotten 5 to 9 years experience. The only ones who've got 15 plus only makes up about a quarter in that sense. And you can see large portions here in the junior kind of quartile. Talking about the VIX and why is the VIX so important, and I don't want to go into too much detail because I know, again, Piers covered this a lot yesterday, but one of the things that we had, if we strip out the movement that we've seen this week, there was a record-breaking run of more than 400 days for US equities not dropping more than 5%. So if you remember kind of Q3, Q4 of last year, that's basically the end of last year, we had all-time record lows that the VIX had ever traded. This is when we were going sub 10 at that point. And so what you can see here are VIX-related exchange tradable products sit just under record assets under management. So a lot of investment strategies being linked to this volatility index, given the fact that it's been so bankable in a sense. There's been such a lack of volatility, which has meant that people have kind of loaded up in this area. And as you can see, the low levels of that volatility completely overlay with the increase here in the amount of exposure the market has, which currently still sits just off that record in the previous reading, but well over $5 billion. Now, Credit Suisse, their share price happened yesterday was they dropped 6%. Now, in part, there were headlines that one of its short-term exposed funds had to liquidate following the spike in the VIX futures, and actually the exchange tradable notes had a market cap at the beginning of January of around $2 billion. So again, these banks being exposed to this in quite high leverage meant that they, particularly Credit Suisse, which is the most exposed in this particular area, got hit very hard yesterday. Other names associated with this type of market, UBS and Citi. One interesting thing though that this brings about, and let me just show you this note here from Deutsche Bank, is a neat study that they've done that maps basically the subsequent VIX moves following the largest 10 spikes. So obviously this discounts the one that we've had this week, but what we're looking at here is only really time that this has continued to see an elevated level of VIX exposure has been when we've had the subprime, like the main part of the subprime crisis. Otherwise, what we've had is that the VIX, basically 9 out of the 10 previous cases, when we've had a big spike in the VIX has subsequently fallen over the 1 week, 1 month and 3 month period, is what history tells us. And as you can see here, by a median basis, or by fairly large increments as well. And so this is why, again, the market probably sees some relative calm, irrespective of the fact that the Dow intraday actually saw its biggest ever loss when it did actually at its low point move some nearly 1,600 points. So hopefully this kind of brings it into a bit more context. Okay, I was going to quickly talk about Germany and the update on the coalition talks, and we've just had a headline come out the last 2 minutes. Germany's Conservatives and Social Democrats have agreed coalition government deal. According to Spiegel Online, Der Spiegel is their main newspaper. They often break the most finance sensitive information. And so obviously these talks, a deal has always been expected. So would I be really hitting the market, want to get long euro or want to get really long the market on the back of this? I mean, for me, a coalition grand bargain was always going to happen. This is just a natural state of the negotiation between which party gets what say and which senior cabinet members get what position and title. Ultimately, this was always going to go through. This was also the third day of kind of overtime talks, if you like. And so there might be some light reprieve on the back of this German press article that's just come out, but I don't think it's a real game changer in that sense. But nonetheless, it looks like there has been some movement this morning. Elsewhere, the other thing, as I mentioned briefly at the very start, you do have a temporary measure to keep the US government funded until March 23rd was passed in the House last night. But if you remember about the last stopgap deal that was done a couple of weeks ago, it wasn't the House, it was the Senate, which is the issue. And this now needs to go to the Senate for it to be wrapped up before, obviously, Thursday, when, again, there is the risk of a shutdown. Donald Trump, obviously, if you've been monitoring Twitter, did comment last night. He said, "I would love to see a shutdown if we don't get this stuff taken care of." Not sure that's going to really inspire the most voting confidence in his leadership. Obviously, I can see the angle he's going for is to kind of play it a bit hardball with getting Congress on side. But we know the repercussion, and as we had before with a few days, I think it was 3 days that the government shut down, non-essential personnel are put on unpaid temporary leave, and this definitely starts to translate into a negativity if that is over a prolonged period. So this needs to be monitored. My baseline expectation is, though, that the Senate pass this, because ultimately this is only going to be around a 5-week extension. This still hasn't really yet been resolved, so I just expect them to kick the can down the road again. And then finally, Theresa May. May's cabinet won't agree Brexit plan this week. So according to latest reports, UK customs proposal is said to be nowhere near ready. And this is because Europe has been putting a little bit of pressure on for the UK to come forward with some more clarity on their blueprint for their discussions with Europe. And this is increasingly making it look like agreeing a transition deal looks ever more ambitious for the March meeting. And as you know, if you've been following me on Twitter, this definitely fits with my view that I think that March meeting is going to be an absolute mess, which I think then will create a lot of negativity surrounding the government's ability to execute Brexit, which will then materialise in the local elections in May, which will then see Theresa May gone as a vote of no confidence. So is this really moving prices right now? No, but definitely it does still fit that narrative of the complexity of the Brexit situation, and at the moment what seemingly seems to be a wish list of demands and not really a lot getting done on both sides, Europe and the UK. Finally, just to have a quick look and an update on the oil inventory numbers last night. If you've looked at your crude oil charts, we have moved a little lower this morning, but we did actually rally last night because the crude headline was a drawdown of just over 1 million. Expectations were for a build of 3.15 million, so we had a much bullish headline than before, and obviously it's a reversal from the builds we had from the prior week. We also had a drawdown in Cushing, just over 500,000, gasoline 227,000, distillates was a larger build though, 4.5 million. But overall, the move has already been paired, but we'll be recovering these later this afternoon as a refresher ahead of the DOE numbers, of course. Now, looking at the calendar for today, you have had a couple of things out already this morning, so just to refresh your memory, you've had at the Eurex Open 7 a.m. German industrial output, a little bit weaker than expected, but again, nothing that's really typically moves market prices. It was only a 0.2 miss on the month-on-month at minus 0.6%. It tends to be a very volatile piece of economic data. Then you've also had Halifax house prices, which I don't think I've ever seen them ever move the market in 12 years of me watching financial markets. And again, they were weak, but the market's focusing on bigger things like dollar movement and obviously political ongoings. Going into the rest of the afternoon then, really there's nothing else much scheduled for this morning apart from a couple of speakers to keep an eye on.
You've got ECB's Lautenschlager at 9. Fed's Kaplan, however, a non-voting member, does speak on monetary policy, and obviously in the context of that uptick in the wage number and this kind of sensitive market environment to inflationary conditions and expectations as being a key catalyst for the sell-off earlier this week. It's going to be very interesting to hear what Fed members have to say. Dudley, who is a voter, will be speaking later on this afternoon. You've also got Fed's Williams as well this evening, and Fed's Evans also speaking. I would say my expectation here is that they continue to toe the line. I don't see that the early part of this week's kind of volatility episode will have any repercussion for the Fed's policy path going forward, which I think will remain the 3 hikes for now, executing the March rate hike. This afternoon then, you've got the all inventory numbers not until 3:30. There's no major 130s coming out of the States, and so it's a pretty quiet day overall in terms of economic data. All right, with that, I'll hand you over to Sam. Have a good day, guys.
Yeah, as Ant mentioned, it's pretty flat on the data calendar, so I won't be expecting anything to sort of really come from that unless you're looking at oil into the afternoon. I think still, before we go have a look at the currencies, obviously you've had that little blip in euro there, and we've already paired where it came back from. Let's have a quick look. Actually, you can see there just sort of spiking around sort of 124, 15 ticks up, and then we're back down now. But yeah, probably the best place to start, I would say, is still with the equity markets, considering everything that happened back end of last week and then the beginning. And you can see, look at that, buy the dip still working in full force. And it was a tricky day yesterday for equity markets. The moves that were happening, even just in the minute candles, were so much bigger than previous days. So I'd be still definitely careful when looking to get in terms of sort of that view going forward. I mean, the safest bet is obviously to wait till the dust sort of settles out a bit. If we have a look at this trend line that we mentioned at the back end of last evening to see how that's holding up, we can see there, well, it's right on it if we look at it, and I know it's exactly the same as Nasdaq, as I imagine. So we'd look to have those on for S&P, Nasdaq. Let's have a look at the Dow to see if it comes up as well. There you go, really nicely respected so far. For that, obviously a break through there could open the door up again, but I think the sentiment at the moment does seem to be the calm after the storm, if you like. Worth having a couple of these trend lines on and sort of perhaps looking later in the day for break tire to get in this sort of messy period where we are now. Perhaps best to leave alone, I would say, but it does seem that you can see how far we moved. If we just have a look here in the Dow, just from that bottom to where we are right now, 6.4% higher. It may look like it's a normal chart, but if we scroll back, you can see how small those day ranges are in comparison to yesterday. For those who have access to trading ladder on the futures, just get that up and sort of see how fast that is moving again today, if it is, and sort of judge whether you want to be in that market. If not, having a quick look back over at the currency markets, the dollar index. Let me just have a quick look before we carry on. Well, unless this chart hasn't updated, it's completely flat for the day, which has been the story really of the last couple of weeks or so. No real direction. It's tried to strengthen, and then you've had a bit of weakness into the closes, or the other way around. So in terms of, and I keep saying it, in terms of a more medium-term direction, longer-term direction for the dollar, it's a hard one to really go for. You've got a bit of this trend line down there to have a look at. It was actually quite a nice trading opportunity earlier when we broke through the pivot, came back, and obviously these comments out of Germany just sort of messing that market up a bit. To the downside, if we were to perhaps push to a new low, it opens the door up to yesterday's low in S1, which, considering the sort of the trend that we've been on, probably not a bad place to look to sort of take profit, or perhaps get back into the trade. To the upside, that that could, if we do see some dollar weakness and this sort of drifting down, ranging down move that we'd see to end, a break above this sort of double top here could be the the play there. Anything in between, and let me just get a sort of rectangle to mark out that area. Probably best, I would say, now to leave that euro alone, especially when you've got a comment like that, which, you know, some people obviously perceive that to be bullish, some people perceived it as, well, heard it all before, as expected, business as usual, and it's just got messy now. I'm going to look over at cable. Obviously, you've got the negative sentiment still floating about, but you know, each day, you know, the buyers do seem to want to come back in late in the day. You can see, you know, here last night as well. Here, so something to bear in mind in terms of that double top we saw in euro. You've got a similar sort of picture here in cable. So I think it would be really more the dollar story if we were to get back up there. So something to keep an eye on. Same sort of pattern that we're seeing here in the pound. If we were to get down low, it does open the door up to that S1 area as well. But again, high to low, it's now getting a bit messy within that range. I mean, just lower the time frame down to see if we've got anything in between. I mean, even the previous low, they're not working too well. These currency markets at the moment are definitely hard ones to be involved in. Probably best to wait for them really to sort of break out their range. Aussie dollar, which, you know, notoriously quite a technical chart. You've got a nice downtrend. Let me just refresh this chart as it seems to. There you go. Let's have a look. We'll probably get a nice sort of trend line going here from the top. Let's have a quick look. Go around. Oh, doesn't want to come up. There we go. Yeah, even there, broken through. So not the best. Lowering the time frame down. I'd be aware of that pivot area. Still looks half decent. You've got the previous lows in there and this 715 high to perhaps continue this trend that we've seen. But even the last, you can see how messy yesterday was, and all currencies in particular. Probably just safer to look for breaks out of the ranges and, you know, confirm breaks at that. Gold, which, you know, I said yesterday, felt a bit weird. It seemed, and then, you know, you can see the reaction in that sell-off that we saw in equities. It did move higher, but then we've come all the way back down now. In what has felt pretty much like the aftermath of Brexit and Trump, in the fact that equities catch a bid and gold doesn't. Where could we go from here for gold? I think have a look at the equity markets to really give you that view, and whether the dollar decides to stay strong or not. Obviously key levels here to the upside and the downside where we found support, sort of stuck within this miniature range. But even if we do push on, you can see it does get quite choppy in terms of areas in the market that could offer resistance and even to the downside support. So I think, just to reiterate the point about the currency moves that we've seen, it has been choppy, and waiting perhaps is going to be the safer bet for that as well. Finish up having a look at the DAX, which as usual is been relatively choppy this morning. We gapped higher, so something to go lower, I should say, sorry. So something just to be aware of there if we were to push on, and that's, you know, completely not out the question. Pivot also acting as support, resistance as we broke through, but you can see even there it's quite messy. The main level, I would say, today to the upside from where we are now, previous low of the day, broke through, and we haven't, you know, really tested that to the upside there. Lows at the moment just getting higher. Worth keeping an eye on there. Perhaps if we can get squeezed in, then we get pushed through, and then you can start thinking about that gap getting closed later on. To the downside, if we were to break out here, you can see the low of the days would be quite a nice target before opening up a bit of room to the low that we saw on the EU close last night. Let me just minimise this chart just to see if anything's moving at the moment. Have a quick look. As mentioned, obviously the data calendar not doing too much. S&P going sideways, so a bit more calm actually in the markets, you have to say. T-notes and the Bund near their highs of the day. The T-notes, you've got the pivot and a bit of noise from yesterday evening to deal with resistance-wise, and same for the Bund. Oil going to be a case of, you know, the 330 data leads the rest of the day. Let's have a quick look at that to finish up. Just moving down slightly at the moment. Worth having a look. You can see that actually that's quite a nice trade there. You can see that low of the day breaking in oil, albeit early doors, and then when we came back to test it, offering a nice resistance S1, you've got a couple of interesting points in the market. But it's going to be a case of waiting for that data for a real confirmed move, I have to say. But nice to see, a good sort of pattern here. Those highs getting lower, it's getting squeezed in, breaks through, comes back and finds resistance. A nice technical pattern coming into play there. Obviously, any questions, please do get them in the chat. I'll be on the desk for the day, so I'll put my camera on as well, and we can talk through the markets. Does seem, touch wood, that the equity market is just calming down a bit. Those ranges in the sort of 10-15 minute candles not doing as much as yesterday, so that could be a sign that it is buying us. But it'll be really interesting to see where we finish the week, I would say. Anyway, data calendar quiet until oil in the afternoon. So any questions, obviously get them in the chat. If not, have a great day.